So thank you so much for doing this, and apologies for getting the surname wrong.
No, pleasure.
So, as usual on here, can we just get you to sort of introduce the fund, please, and what you're trying to achieve with it?
Sure. Maybe it helps for me to give a bit of background about the firm first, and then very, very happy to dive into the fund and what we're trying to do. The two are very, very closely linked. So the GSEO fund, as it's known, the Global Sustainable Energy Opportunities PLC, is really a reflection of our strategy, and our mindset, our backgrounds with respect to being global financiers in energy, and having spent the bulk majority of our respective careers, investing and financing energy projects and companies around the world for, on average, at the senior level, nearly 30 years. And so the company today is a team that has basically spun out of Mizuho Financial Group. Mizuho is one of the three Japanese mega banks, one of the largest project financing banks on the planet, a near $2 trillion balance sheet player. And in the May of 2020, we agreed with the board of the bank to take a team out of the bank to create what is today Victory Hill. And we launched, as you know, the GSEO fund, or the GSEO trust, in February of 2021. So 2021, we IPO'd the trust on the main market segment of the LSE, and we raised just about 243 million pounds. And the idea was really to come to market and capture what we think is the global energy transition opportunity. So our firm and our purpose is to invest, investor capital around the world in the energy sector to help promote and indeed accelerate the energy transition. The firm itself overall intends to carry out activities in energy infrastructure and in private equity on a global basis, and we are entirely focused on energy investments alone. We do nothing else. We are dedicated to this sector. We think there's more than enough to do around the world, and more than enough capital requirements around the world to help maintain and achieve indeed the energy transition. So that for us is our sole purpose and our main goal. The firm today, as you all know, is London headquartered. We are 100% partner owned. And to date, we have in our flagship fund, the GSEO Trust, we have about 475 million pounds as at September 22. And there are currently 20 members of staff here in London. We're based in Mayfair. We have in the strategy itself, in the fund, we have about 29 assets invested to date across 5 different joint ventures. And we are across 4 different countries: the United States, Brazil, the UK, and Australia. And we're going to dive into that a little bit more. But effectively, the team, again, has been projecting its experience in over 43 different countries, its past experience in over 43 different countries in energy through this particular fund. And we are bringing to bear many more interesting opportunities around the world. Okay. So with that, maybe we can move on to the next slide. Just to give you a flavor of the team, this is a very important slide because I think you'll get a sense of who we are and where we come from. This is really shows you that Victory Hill is nothing short of really being the United Nations of the investment management industry. We reflect the diversity and the cross-border nature of our activity through our people, and we hire a very diverse set of people from diverse backgrounds. It's one of the beauties of this particular organization in that there are many languages spoken, many ways of thinking, and we value that tremendously. Our activities are carried around the world. Everyone here has, at the very least, 4 to 5 years of experience in a relevant field, meaning investing in the energy sector or being in the asset management industry, in infrastructure investments or private equity investments. And so everyone here, at minimum, has at least 4 to 5 years under their belt. And it is a pretty experienced team overall. We're very happy with that. Maybe moving on to the next slide. Here is really the energy transaction experience that we've brought to bear here. So within the context of the team's experience, We as a business, have been carrying out energy financing and investment, activity for, as I said, at the senior level, nearly 30 years. I suppose with younger members of staff, the average comes down to around 17.4 years of average energy finance experience. And as we grow, that'll probably continue. But on average, we've completed over 176 transactions around the world across $304 billion of deal values. And the great majority of that has been published in our IPO prospectus has been fully audited by indeed 2 law firms. So it is a fully audited track record. In sustainable energy specifically, the team, as a unit, while at Mizuho, have completed over $37 billion of transactions, working within the Mizuho realm before we spun out and created Victory Hill. And we have achieved over 24% of investment returns within the context of that portfolio and that track record. And again, this has been fully audited. At the bottom, you can see what the GSEO fund has been investing in since we IPO'd. We're very proud of our execution track record in particular. We have an ability here to earmark, and this is really, I suppose, a culture of execution here at Victory Hill, where we tend to earmark investments early on in the process and make sure that we go out to raise capital and seek to raise capital on the basis of tangible opportunities that we've pre-identified before raising the capital. So what we don't do, otherwise said, is we ask investors for money on the promise of something that might happen in the future, i.e. what we call in the industry a blind pool. We don't do blind pool raising. We always raise against a tangible, secured opportunity where we feel very confident we're going to be able to deploy. And I'm very proud of the team, of our execution track record. It makes a big difference in this space, and it is a big differentiator that we have here. So to date, if we go on to the next slide, the performance, to date, as at December. So these are the last marks that are coming out. We've already published our latest NAV figures. To date, we carry a NAV at around 108.2p. The portfolio valuations, have come down a little bit as a result of, some supply chain, delays, but we have been generating a huge amount of cash within the context of this strategy. This strategy is extremely cash generative, and we're very proud of that. And I think it's really answers the call of the bulk majority of our investor base, who really want to have a stable, solid, cash flow generation and income generation within this strategy that they can hang their hats on. And so as a result, we've decided we wanted to reward investors with a large proportion of that cash generation by increasing the dividend for this coming year. So 2023, we've just announced we will see an increased dividend. We've increased that by roughly around 10%. And I think investors will enjoy that. And we maintain at the same time a very, very high and ever increasing dividend coverage ratio. So within the course of last year, the dividend coverage ratio was around 1.4 times. This year, we anticipate it will be slightly above that, around 1.5, and it will continue to grow as a lot of our construction assets become operational. We're going to dive into that in a minute. But as you see on this slide, the target, total return of this portfolio is around 10%. And this portfolio, unusually while income generating, also provides capital growth. This is a big differentiator, I think, from other strategies that are really oriented towards generating income alone. We generate as well capital growth, and there is quite a bit of capital growth that is driven by the fact that we take positions in greenfield or construction assets. And I'll explain that in a minute. We're globally diversified. We look for high impact value. This is very important. All the assets are actively managed. So we don't just buy an asset that is long-term contracted for 20 years and sit on that. We basically like getting involved in the asset and seeing whether we can optimize the asset to increase the returns for the benefit of our investors. And so we look to change the contracts or the offtake arrangements, the commercial contracts. We look to see if we can, for example, optimize the asset by investing more into the asset, by expanding the capacity, or in some instances, even hybridizing. Hybridizing means taking, for example, a solar farm and adding battery storage behind the meter to give it more versatility and allow it to become more relevant to the grid system and increase returns ultimately, again, to investors. So we have minimal exposure to power price movements. We have, a fully contracted really portfolio. We have a bit of merchant exposure in places like Australia, where we want to specifically take merchant exposure, where we think the Australian market really presents a very, very clear case for upward lifting power prices, which at the moment the portfolio has really been benefiting from throughout the course of 2022. And then we are certainly long-term inflation-linked pricing. So we are linked to inflation across all of our commercial contracts, which is a very, very good thing. The sensitivity to inflation in this portfolio is very, very low. So on the revenue side, strong inflation linkage, all in local inflation terms. So in our contracts in Brazil, it is linked to local inflation. In our contracts in the United States, likewise. In the UK, again, local inflation, and the same in Australia. So across the board, we look for inflation linkage, very, very important. And one thing I will mention around the inflation linkage is in our discount rates, there is a very low sensitivity to inflation because all of our portfolio at the moment is fully equity invested, meaning there's very, very low leverage. There's very, very low debt utilization. And as James just mentioned a minute before, if we were to take out debt today, it'd probably come at a very, very high cost. And he's right. He's absolutely right in saying so. We manage that debt proactively. We don't like taking debt for the sake of taking debt. We want to take debt when it helps the case for paying our investors, for generating more income and generating more EBITDA, and generating the NAV growth. Otherwise said, we want to promote leakage to equity. And so that's very important for us. We don't just take debt for the sake of taking debt. We really look to choose strategically when we utilize debt and how we utilize debt and at what cost. Last but not least, we have obviously a very, very strong environmental social impact orientation in this strategy. And we publish within our annual financials. I encourage everyone to take a look at that in more detail. We publish a lot of data. We do life cycle analysis with respect to carbon impact. We get involved in understanding carbon payback periods, and we also do a lot of social analysis. We're very lucky to have hired a head of sustainability here in Eleanor Fraser-Smith, who has come from an industrial background. So instead of having the usual reflexes of an investor background, she actually understands supply chains. She understands how the industrial part of the industry works. And we have huge amount of insight as a result into our supply chains and into all of those aspects of our impact through our investments. And of course, the result is that we are able to satisfy SFDR Article 9 requirements. Indeed, the fund is EU taxonomy aligned to a great extent, and indeed our sustainable focus, which is, I think, obvious, allows us to be aligned with Article 9 indeed. Maybe on to the next slide. There we go. This is a very important focus of our strategy with respect to how we think about originating investments. We have about 6 specific UN Sustainable Development Goals. You may be familiar with the so-called UN SDGs, Sustainable Development Goals. There are 17 in total. And here at Victory Hill, we focus on 6 specifically. The way we work here is we look for investment opportunities for this portfolio by ensuring that these investment opportunities are screened against their purpose with respect to the SDGs. These SDGs are long-term goals. We try and find these investments that align with these long-term goals. So if you look at SDGs 3, 7, and 13, these are 3 SDGs that were identified by the International Energy Agency as relevant to the energy sector. So that is the reason they're here, and we focus on them. 8, 9, and 17 have to do with a focus on infrastructure investments in particular. And so as this is an energy infrastructure strategy, these are the 6 appropriate SDGs to focus on. Once we have assessed that a particular investment complies and aligns with the meaning of the goals and the intentions of the goals, then we can move on to really assessing whether indeed these investments align with the transition itself. These investment pathways in climate change, energy access, and energy efficiency and market liberalization are manifestations of the energy transition around the world. No 2 energy markets on the planet are the same. They are all different. They all manifest themselves in different ways. And surprise, surprise, the energy transition likewise manifests itself in very, very different ways in different energy markets around the world. And so alignment with these 4 manifestations, one or several of these manifestations, is very important for us to understand where an investment is on the journey of contributing to the transition. And then last but not least, one thing that we do as a sanity check is we ensure that even though we have 6 SDGs that we comply with, we work with a third-party consultant to make sure that we don't breach any other of the 11 SDGs that are non-core. So we have these core SDGs, 3, 7, 13, 8, 9, and 17. And then there are 11 other SDGs, some like world hunger or slave labor or child labor. These sorts of SDGs are very, very important, and we want to make sure we don't breach them. So we make sure that we assess whether our suppliers are compliant, with all of these SDGs as well, so not to cause any harm to them. All right, with that, let's move on to the next slide. Here you have performance to date. We are, really, in a period at the moment where the share price is trading at a significant discount, really, to NAV. We have seen the NAV drop lately as a result of supply chain delays. And this is simply due to delays, basically, in some of the projects, nothing more. We have seen the NAV come down as well as a result of some FX movement. This, again, is not realized FX movement. This is book movement, so bookmarking. The FX exposure in this portfolio, you'll understand, is fully mitigated in the sense that we obviously hedge on a 6 to 9 month rolling basis using forwards all of the dividends that are coming out of the portfolio. And indeed, the dividend distribution, has done very, very well. The fair value movement of the assets, has come down a little bit as a result of some construction delays, in particular in Brazil, which has been broadly announced to the market now, and some Forex movement, which is, again, book movement. And so the NAV is down a little bit, but once we finalize the construction of this portfolio, what you experience is these steps that you see going upwards in the middle of the chart there on the NAV. Those steps are the result of us completing construction. What happens in this portfolio when you carry a lot of construction in the portfolio, about half of the portfolio is in construction, once those construction projects become operational, there is an uplift in the NAV. And this is because when they're in construction, we carry these assets at cost. Once they become operational, we then have to fair value them using the cash flows that are being generated once they are in operation. And so that typically results in an uplift in value for the assets. And it's a very, very nice way of creating momentum in the growth of this portfolio on an ongoing basis. Obviously, if some of the construction is delayed, then obviously there is an impact on the NAV as well, and that's what we're experiencing at the moment. But that will certainly be completely addressed in the next couple of months as we're proactively involved in all of our assets. Okay, so with that, maybe moving on to the next slide. Here we are. So a lot of this is a recap, really, of what I've mentioned a minute ago. I do want to touch on 2 or 3 things in terms of the activities that we've been involved in the course of last year. To date, as mentioned, about 53% of our portfolio is in operation. And you've seen the buildup, basically, of that portfolio, throughout, the chart that I've shown you before on the NAV side. About 16.5% of the portfolio is in construction at the moment, and that is the part that has been lagging and affecting the NAV as a result. and then 23.9% is committed to date and not deployed. These are projects that are part of a program, an existing program with developers, and you'll see some announcements, coming up, in the next couple of months or so. We have about 6.1% in cash. We always manage a bit of cash, for the purposes of, being able to be efficient with respect to treasury. We have a dedicated treasury strategy in this portfolio. We've completed this year in 2022 a large acquisition. This was actually, it turns out, the 5th largest transaction in Latin America in 2022 in the energy sector. We're quite proud of that. We had no idea that was going to be the case. We acquired the asset on its merits alone. It was a Brazilian hydro power plant, which is a beautiful power plant in the state of Espírito Santo, in Brazil. And we acquired that from EDP, Energias do Portugal, and their subsidiary in Brazil, Energias do Brasil, which is the 4th largest utility in Brazil. We made a lot of noise with that transaction. It's a beautiful facility, and the cash that is emanating from that particular investment is really serving our investors very well with respect to being able to support the dividend and provide additional dividend coverage over time. With that, we've increased as well our portfolio in Australia with additional PV sites, and we continue obviously on time, to be delivering our flexible power plant in the UK that has carbon capture and reuse technology on it. This is a really innovative technology. We're really excited. It's a partnership with Rolls-Royce, Mitsubishi Turboden, and ASCO. Carbon dioxide. This is a really, really interesting solution that is going to help stabilize the grid in the UK. And that is the sort of thing that we like doing. We like addressing the crux of the issue in different energy markets around the world. And so, as I mentioned, in Brazil, about 9 of our sites are fully completed now, and we are waiting, obviously, to finalize the last 9 sites out of our 18-site program of distributed solar generation. So with that, let's move on to the last slide, and then I'll stop here and turn back to you, James, if that's okay. On this particular front, this is a makeup of the portfolio as it is as at December. This is the very latest data that we have. It is, about to be published, and certainly very, very clear for all to see now with respect to where the portfolio sits. We're very happy with the mix. We will be adding in the near future more technologies. This is one of the advantages of this portfolio and of this team's capabilities, is we're technology agnostic. We've invested in virtually every single technology and energy. We understand all of it. We have looked top to bottom in different parts of the world. It is a very unique competence, I have to say, and I'm very proud of the team and its ability to be able to do so and deliver performance for investors as a result. And so you'll see more jurisdictions, more technologies, no doubt, in the months to come, and we will be reducing over time as well the construction exposure in the portfolio as obviously we get this positive uplift in the NAV from construction coming to bear. The committed not deployed component in the portfolio in the pie chart on the right hand side is future commitments to greenfield situations. So these are construction yet to come. There will always be some construction in this portfolio, but we want the overwhelming majority of the portfolio to be operational. The dividend coverage, once the whole portfolio is operational, is going to be very interesting for investors, I must admit. I think this will make a lot of noise in the markets. We have created a portfolio that is very well cash flow sustained, and that is one of the unique features that we have here. I'll stop here with that. Maybe back to you, James.